Is silver about to move 226% to the upside? And so it begins. SWIFT to test central bank digital currencies for international transfers. They said, we are testing how SWIFT can interlink the multiple domestic-based CBDC networks emerging worldwide to make cross-border payments with CBDCs more seamless and frictionless. Here we go, folks. Buckle up. India's central bank buying tons of gold. The RBI's purchase of gold in financial year 2022 was large at 65.11 tons, the highest since 2010. Gold now represents 7% of forex reserves at the end of March. It was 5.8% at the end of 2021. And with the World Economic Forum's meeting in Davos happening at the moment, we thought we'd have a look at this article from ZeroHedge, where Ray Dalio says gold reduces risks, enhances returns, and belongs in your savings. Now, the main thing I want to read in this article is just this one little clip. Remember in 2015 when Christine Lagarde said to Ray Dalio, Ray, stop talking about gold. I wonder why these global elites don't want Ray Dalio and others talking about gold. So Dalio wrote a book, Principles for Dealing with the Changing World Order, and it's pretty good. There's a few economic things that I think Dalio gets wrong, but there's a lot of really good stuff in there that he gets right. But if you guys don't like reading, Ray has done a fantastic 45-minute video that I just want to share, and I'll put a link in the description below. I highly recommend you guys watch it. But let me just share with you a 3-minute clip from that video.
When I dug into history, I discovered that the exact same thing happened in 1933 and had the exact same effect. Then paper dollars were also linked to gold, which the U.S. was running out of because it was spending more paper money checks than it had gold to exchange for them. And President Roosevelt announced on the radio that he would break the country's promise to exchange dollars for gold.
It was then that I issued the proclamation providing for the National Bank holiday. And this was the first step in the government's reconstruction of our financial and economic fabric. The second step, last Thursday, was the legislation promptly and patriotically passed by the Congress, confirming my proclamation and broadening my powers so that it became possible, in view of the requirement of time, to extend the holiday and lift the ban of that holiday gradually in the days to come. This law also gave authority to develop a program of facilitation.
In both cases, breaking the link to gold allowed the U.S. to continue spending more than it earned, simply by printing more paper dollars. Since there was an increase in the number of dollars without an increase in the country's wealth, the value of each dollar fell. As these new dollars entered the market, without a corresponding increase in productivity, they went to buy lots of stocks, gold, and commodities, and hence caused their prices to rise. As I studied more history, I saw that the exact same thing happened many, many times before. I saw that since the beginning of time, when governments spent much more than they took in taxes, and conditions got bad, they ran out of money and they needed more. So they printed more, a lot more, which made its value fall and made the prices of most everything, including stocks, gold, and commodities, rise. That's when I first learned the principle that when central banks print a lot of money to relieve a crisis, buy stocks, gold, and commodities, because their value will rise and the value of paper money will fall. This printing of money is also what happened in 2008 to relieve the mortgage-driven debt crisis. And in 2020, to relieve the pandemic-driven economic crisis, and it almost certainly will happen in the future. So I suggest that you keep this principle in mind.
And Jesse Felder shares this Wall Street Journal article. 1974, the Fed kept raising rates even as a recession took hold because it was running to catch up with inflation. Sounds familiar today, doesn't it? The result was a horrible bear market interspersed with soul-destroying temporary rallies. From Andrew Sinclair, the longest bear market was 21 months, from 73 to 74, i.e. stagflation. The deepest bear market was 57% during the GFC. Average is down 30%. We're only down 20% so far and barely 3 months in. So we're really starting to see people talking about a longer duration bear market in equities, and especially, talking about 1973, 74. And on this chart where you can have a look at all these bear markets throughout history, I think this is the 1973, 74 bear market. Now I could be wrong, but I think that's the one there. And for Australians, this is a big warning. This is government bond and TFF maturity. So this is a term funding facility that the RBA gave the banks at 0.1% over a 3-year term. Look at the maturities. 2023, the banks, all that borrowing, 200 billion, needs to be refinanced. And guess what? The market is now. It's not 0.1%. Banks are going to be paying a lot more for this debt. And then in 2024, it gets even worse. And then you got the, semis aren't a problem. That's doesn't seem to be a big problem. And then government securities, Australian government securities, there's a lot of maturities happening. And with higher rates, we're seeing this in the corporate bond market as well. So, there is a risk around zombie firms, and I'm going to talk about that in a near future video. The risks I see with zombie firms in the corporate debt market, and also just in the home loan market. Lesson of 1973-74 bear market. Sell the rips. Conditions ripe for a deep bear market. The risk is a series of bear market rallies that don't last, hurting dip buyers and further damaging investor confidence. Lesson of the 1973-74 bear market. Sell the rips. From the Wall Street Journal. In the bear market between 73 and 74, it took 20 months before the low was reached as the Federal Reserve was increasing rates to fight off inflation, CPI, even as it fell into a recession. Sounds similar. 1972, gold was up nearly 50%. In 1973, gold was up nearly 75%. In 1974, gold was up nearly 70%. So when we go to macro trends, you can have a look here that, in 72, almost 50%, 73, almost 75%, and in 74, almost 70% for gold. And then in the mid-70s, it went nowhere. In fact, it went backwards, gold did, until 1977 when it started to move up. 78 started to move up, but the real big move was in 1979. And when we look at silver, you can see that silver in 72 up almost 50%, in 73 up 60%, and then 74 up 37%. And then once again in that mid 70s went nowhere, went backwards a little bit, and then in 76 really was flat. 77 started to go up, 78 started to move, and 79, well, we had a big move in silver. So if and I've been banging on about 1973-74 style event where the markets fall 50% in nominal terms while CPI remains elevated. Well, you can see what gold and silver did during this period. And if it replicates or rhymes, then we're looking at a 226% return just in this period alone, not taking into account the late 70s, just this period here. Because if you go, at the end of 71, silver closed at $1.37. By the end of 74, it closed at $4.47, which is at 226% gain. So when we put today's price of silver at $21.75 in a calculator and put that percentage change of 226%, then we're looking at a final value of right on $71. So what's that? $71. Are we looking at silver hitting about $71 in the next couple of years? So by what? 74, let's say 224, looking at about $71 silver. Now, I did a video, $125 to $714 silver, where we just looked at the 1970s bull market for silver, and compared it to this decade that we're in now, this inflationary decade. There's a lot of similarities. There's a lot of differences as well. But this video was more specifically looking at the back end of the 1970s. So if you haven't watched it, I'll put a link in the description. It's a good video, a good educational video. And in that video, I shared this chart, length of silver spikes, and you can see that 73-74 period, 144.2%. So using this calculator, if we put 144.2% in, then we're looking at $53 silver, so all-time high silver. And if that does play out, then the miners in particular are just going to go ballistic. So yeah, I am bullish silver from a supply-demand reason, from a industrial demand reason, but also from a monetary reason. There are a lot of similarities. Yes, I said there's a few differences as well with this decade I believe we're in and the 1970s. I've been calling for a long time now, 1973-74 style event. You guys are probably sick of hearing it from me. But now we can see that a lot more other people and mainstream are starting to talk about it as well. And, what we got to do is look at what performed during those periods, and certainly gold and silver performed very well. And as they say, nothing is repeated, but it certainly does rhyme. And even if it's not 144% gain or a 226% gain, I do see silver much higher than where it is today. And silver miners and silver explorers give me even more leverage on the underlying silver. But I think we are headed for a monetary crisis. The elites are meeting in Davos right now. It is clear SWIFT is now trialing international payment transfers with domestic central bank digital currencies. That's just around the corner. This monetary system, I've done videos about Zoltan. He's talking about the change. We're coming to an end. This 40-year bond bull market, this wonderful period of financial wealth is coming to an end, in my opinion. And so people need to look at what happened before the bond bull market started. Anyway, what do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, guys, please hit that like button. We really do appreciate it. If you haven't yet subscribed to the channel, do so. And also hit that notification bell so you get all my videos when I put them up. Anyway, guys, take care. And I'll see you all again on another episode of Finance Uncut.